Good afternoon, ladies and gentlemen. Thank you very much for attending our webinar today. We're live on YouTube, as well as obviously live in Singapore, as you can see from behind me. We're using, if you're using Zoom, then you can ask some questions. My name is Andrew Talbot, and today we're going to talk about how to retire as an expat. So we'll go through some of the main points that this subject will bring up. It's not going to be in great deal of detail, so please get in touch with us afterwards, but it's really just to give you food for thought, some of the areas that you might want to think about, some of the areas you may not have thought about, and hopefully it will just spur you to doing some planning or for us to get in touch. That's me in the corner. I'll turn it off because it can be a bit distracting, but if you're obviously set it on YouTube, get in contact us afterwards, and in Zoom, by all means, ask questions as we go along. Okay, so as I said, subject: how to retire as an expat. And you've probably an expat at the moment, have been for a while. Your families may be here with you, so they've experienced the expat culture, they lived abroad, they are citizens of the world, they understand different cultures, they may not go back to their home country or your home country. You may have nationality families, your spouse might be from a different country. So lots of different factors involved. So you may retire to another country. These are some of the areas that I think everyone will probably need to go through. You may retire to your home country, or you may split your retirement to different countries. And it really depends on your own personal circumstances, whether or not you fit into one of those categories. And again, I think being an expat for a while, maybe your home country ties tend to disappear. Or it really depends on where's your family from. Did you enjoy living in the country that you're from, and everything else that goes with that. I've got a little bit of a cough, so apologize for that in the meantime. So where will you live? This is a report from a fund management company called the Global Retirement Index, and the link's down there at the bottom. It's really talking about the factors involved in why someone would where they would live. So finances, retirement, material well-being, quality of life, the health, life expectancy, the quality of the health system. So these are the things that everyone seems to will think about. So you have to look at the country that you're going to retire in. Maybe it's your own home country, and see whether or not it's very attractive to do that. What are the factors affecting your retirement? So what do you need to think about? The first one is your health. What is the health system like in the country that you're going to retire to? Or if it's split, health insurance costs will go up as you get older, and they are going to go up in general because more people will claim from it, more people will get involved in buying it. So the health insurance costs will certainly go up. It's one of the areas that I think retirees overseas seem to forget or are unaware of. How much income do you need? What's your number that you need to live on? What's your expenses? Where are you going to get all that retirement income from? The currency. If you're in multi-jurisdictions, you're going to have at least two currencies. The amount you earn in, the amount you and the currency you spend in. The more you've been away, the more you'll have assets in the different currencies, and this can move with you or against you. So it will increase either your retirement income or it will decrease it. So it is very important to understand what currency you're going to be spending your later years in, and how do you manage that? Tax. Every jurisdiction has a different tax rate. Some will be territorial, i.e. there'll just be one country, and some will be worldwide. depending on where your residence or where your citizenship is, will depend on what kind of tax rate you will have to pay. So, and how you generate that income. So the sources of income, which we'll come on to later, all will have different tax rates. So understanding how much you need, how much you're going to have to pay at each stage will determine whether or not you go down that particular asset, or whether it's just not feasible to do so. And then property. You need a place to live or a place to retire to. You may have a rental income, but it really depends on where that property is and what again the tax rules are. What's the rules of ownership or residence in that particular country? Can you own property? And then travel. One thing we've noticed with clients who are retiring overseas is that, as I said, the family's probably been there for a while. They're used to traveling. They're used to different cultures. They've got friends all over the world. You tend to travel a lot more probably as an expat than you would from somebody who's probably stayed in their home country their entire time. So the travel costs do go up in retirement. So can you see into the future? How much do you need? So what is your number? What is the amount that you will spend in retirement? So what are your expenses? And then can you see any unforeseen events, which is generally health cover, long-term care? Or do you need to leave that country very quickly? Do you need to pay tax to leave? How do you sell a property? Everything that you think will happen. Certainly with the UK leaving the European Union, that's brought up some unforeseen events for retirees in Europe, where maybe their health cover is likely to go up, or they're not going to get health cover. Their pension they're receiving from the UK has dropped because of the currency has dropped substantially. Or if you're in Asia, some of the local currencies have dropped substantially just because there's been some local unrest, Malaysia, for instance, or you're having to return property to the local government, Thailand, Indonesia, Vietnam. So it's all of these events that will happen. So you need to make sure that you understand what the risk levels are with that. And then how often are you going to travel? As we said, your children may be living in different parts of the world, and they may be going to university, so you need to fly to see them, or do they fly to see you? You want to see the grandchildren and everything else that goes with having a family. So if you own property, as I said, you need a place to live. So you need to either do you pay rent or do you own that? It's unlikely that you have a mortgage in retirement, mainly because banks won't lend. But you really need to think about how we affect that. And then also, what about a holiday or a retiree home, or a place that you're going to go for the summer months or even the winter months? What are the local taxes in that area? Can you own it? So if you picked a mature tax jurisdiction, for instance, such as the US, Europe, UK, Australia, New Zealand, you're going to be paying taxes on it, but you do actually own the property. So you own that, you may own that land. Whereas if you picked another jurisdiction, another country such as Thailand or Indonesia, it's not necessarily you actually own the property. You may just be having a long-term lease, at which point you have to give them the property back at the end of that lease. So it's worth considering those factors. For example, if I look to the tax on property in the UK, you're going to be paying tax on the rentals. 20% is actually, it could go up to a lot higher than that, your marginal rate. Capital gains is going to be 18 or 28%, depending on how much your income tax is. And then there's likely to be an inheritance tax of 40% on that asset. And if you wanted to buy a buy-to-let, then you're paying an extra 3% stamp duty at every banding. So it can be quite expensive to hold the property from just by the tax you pay. So it's understanding, well, what are the maths, what are the numbers involved with that? So then we come on to creating these multiple streams of income. And you need to know what your number is. What is your number and how are you going to get to it? And it's not just a case of having one pension plan or one portfolio. the risk is too high in assuming that that will continue to pay your income that you need. And there are the other factors that we talked about, currency, tax, etc., that will have an impact on this. So you may just use cash in the bank, just draw down on it. Obviously, if it's different currencies, you're going to have different bank accounts around the world with different amounts in. Rental property, talked about the tax available on that, or whether you own it in different jurisdictions, but it will provide an income in retirement. And it's a well-known strategy at the moment for people to have multiple properties that provide in that income. You also get capital growth on top of it as well. A small business, side hustle, I think it's called these days, where you maybe have a different an equity stake, or you may be involved in the next stage of a retiree career. You just operate in a small business. Part-time work. Generally, people don't just stop working. They will go on to consultancy, go on to projects, provide an extra source of income in retirement. And then there's obviously the government and social security. So UK, for instance, you have the basic state pension. In the US, you have some degree of social security. So it's providing you with that another income stream. And then obviously there's a conventional pension, working out what your pension scheme is, whether it's from a company one or a personal one. All it's going to do is provide that income. So it's understanding how much it can provide and how much of that is of your total amount. And we'll come on to a case study shortly about how to build this. And there's obviously a portfolio. Will it provide you an income, or will you have to take capital withdrawals from it? And I will obviously go into detail of that. So there is a concept called a tax nomad. Effectively, you're a non-tax resident in a number of different countries. Usually it's 2, possibly I think it's about 3 that you need to do it to avoid being a tax resident. It's generally 183 days in each country, or 6 months, but sometimes you have to get it down to 3 months because they take into the fact that you have got ties to that particular country or that residence. It's becoming more and more difficult to do, and there's changes in tax systems that make it difficult. Countries want to raise revenue, and this is a very good way of taxing people that are part resident. The disclosure, again, is becoming more and more freely available to tax authorities. The CRS is called the Common Reporting Standards. Just means that information is flowing between jurisdictions. So, for instance, in Singapore, they will give the US tax authorities all of the data about the residents in Singapore and what they hold. So, if you're a US resident and you're trying to hide from that, then apart from being illegal, it's very difficult to do. So, having that offshore bank account sitting in one of a Caribbean island or a Channel Islands is now going to become incredibly difficult to hold it there, because the tax authorities will know that it's there. And if you're not declaring any income from it, then you're liable for penalties. So be aware of that. So as I said, we come on to a case study. This is a bit of a tax case study. It's very rough calculations, but it's just really to give an idea of how it works. So if we took Mr. and Mrs. Smith, UK nationals, both in the late 50s, lived overseas 20 years, kids are in different parts of the world. They've got a home in the UK and a home in Europe. And I picked Europe for a particular reason. They think they need 75,000 to retire. So they've worked out what their expenses are. They know they've got to pay flights. They know they've got to pay maybe some extra health cover. So they need to, this is what they've done their calculations on. So they will receive state pensions each of about £8,000. Mr. Smith's got a pension that provides 35k. And then a buy-to-let property that provides 12k, and therefore they're short 12,000. So they need a portfolio of about 300, and they reckon that withdrawal rate 4% generate that 12k. So it's quite rough calculations. There's lots of other factors involved in this, so it's not quite as straightforward as this. But if we took their tax bill, UK, he'll be paying sort of 9k. Mr. Smith is going to pay 800, so he's going to be a higher rate taxpayer. She's going to basically be a basic rate taxpayer. There's other income that will come into it, and it depends on how he draws that income down, whether or not he will pay tax on that extra amount. So what about the other country? So where are they going to be staying? So if you're in somewhere in Europe, then you got to understand, well, what's the other country tax there? Will France, for instance, tax a UK pension or the rental income they're receiving? What about if they're living in Spain? Do they need to declare that income? So it's important to understand, well, what's the tax position there? And also, what is the double taxation agreements between them? So do you need to declare the tax, or does the taxation agreement say that tax will be paid in one country but not in another? And then what about changes? So Europe obviously was picked for a reason, because you need to, it will change in the future whether or not those double taxation agreements will work. You're going to lose your health cover because of the reciprocal agreements between the UK and Europe. So these changes will make a big difference to how Mr. and Mrs. Smith will now approach their retirement, because they now may have to pay an extra bit of tax. Currency is obviously going to have changed quite substantially. The pound has dropped considerably against the euro, probably when they started retiring. So they're now going to fund that extra amount. So planning your portfolio. It normally comes down to three areas: why, how, and where. So why is the goals and the financial planning that we talked about. Setting that number, understanding the tax, understanding the currency. How is, what vehicles are you using? Are you going to use a tax wrapper? Are you going to use property? What is the stream? Where is it going to come from? And then where is funds, investments, bonds, and shares? And this is the area I just want to talk about now, which is the portfolio construction. So in retirement, you're trying to really generate an income. And really, how do you do that? Do you generate an income from the portfolio by having bonds that pay coupons or shares that pay dividends? So your income is set from there. So if we took Mr. and Mrs. Smith's case study, they had 300K, they wanted to trade 12,000. So what do? Do they put that into a sort of a share portfolio that's going to provide that income? The current dividend yield on the FTSE 100 is about 4%. So they could, in theory, do it. Or do they take capital? So they change their portfolio. They're looking for a growth strategy and then taking the profits from it. And each has different risks. So if the share dividends drop substantially, then they're not going to be able to get that income. Or if there is no growth in the portfolio because we've had a change in the direction in the FTSE or the markets, then it's not necessary that they're going to be able to cash out those profits and take their income. So the different risk levels really depend on which strategy you're going to take. And obviously the markets will make a big difference to it. There's a bit more information on this on my website. This is the best way to maximize your retirement income. So it goes into a bit more detail about, look, how do you do it? What are the factors involved? It's not going to change the fact that you still need to do the planning. So how much do you need in retirement? How many years you've got to go? How much do you need to save to get that? Or how much growth rate do you need to achieve that? Are you going to be short? What's the allocation? Do I need to go 100% equity, or do I need to have some mixtures into it? And it's the same in retirement. You're just extending that period. So set out your goals and say, this is what I want to achieve, and this is my risk level that I want to do it. Picking the asset classes will make a great deal of difference to that. As said, if you're taking an income from a portfolio, then really you're going to go for fixed interest securities, so government or treasury notes, maybe local authority, etc., to provide that coupon, some corporate bonds. But if you're going for a growth strategy and you're going to take profits, then you need to have equities because you need the growth on it. Or property, you're going to say, well, that gives me capital growth and some income. You can't take the capital growth on a property. You can't just cash out of it, but you can get an income. You'd be taxed at it, but it's worth considering. And then also the other stuff like alternative investments. And this really is trying to work out, well, what is my strategy? Am I going to get an income, or am I going to get the capital growth? And we talked about the risk level. So it's not just about being up and down. That's volatility. That's a market going up or a market going down. That's not necessarily all of the risk associated associated with it. As an expat, the currency risk is one of the big factors to think about. The movement in sterling the last couple of years has really either added a lot of value to people's portfolios, or it's taken a great deal of it away, depending on where you're positioned. If you were buying into UK assets now, you can buy a lot more than what you could do a year ago. But if you're traveling overseas and your assets are in sterling, then you can buy a lot less because the pound's just not going to go that way. So the currency for some people is probably a bigger risk level than the actual volatility, or the fact that the markets have gone up and down. And the same with, say, credit risk. If your portfolio is bond denominated and you're trying to get an income from it by having the coupons to pay it, then the credit risk is going to be a lot more than what the volatility is on the stock market. So it's understanding where does your risk sit, and your portfolio construction, or how you take your income in retirement, will really dictate that. So a couple of things to do. Start with, how much do you need? What's your goals? What's your number? Where are you going to get that income from? Consider the time scale. How long have you got until you need to hit that level of retirement, or is it a phase of retirement? Are you going to take income from other sources? What is your risk? What type of portfolio are you going to do? Is it going to be that growth strategy, or is it going to be that income? And obviously, where do you live? What country are you going to be in? Because the currency and tax is going to have an impact on that. And then selecting your vehicle or tax wrapper. Is your income stream going to be a range of rental properties in different countries? Or is it going to be a conventional pension scheme, or a portfolio, or cash? And then you're constructing that portfolio based on the factors of having taken an income or taking capital. I would say there's probably a combination of all of it, rather than just, I'm in this pigeonhole, this is my box, I take income. I think in property you would be taking an income because you can't take the capital growth. So that vehicle or that tax wrapper will dictate that. So that's us for today. There's a couple of links in the presentation. They're on the website. So get in contact us by going to that, or emailing me, phoning me, and if you're watching on YouTube, then those are probably the best ways to do it. But hopefully it's a bit of food for thought. It's quite a short webinar. We'll see what the next one brings in a month or so. But thank you very much for participating today, and I hope to speak to you soon.